What are the key milestones of Islamic finance history? Have you ever wondered how Islamic finance has evolved over the centuries? The journey of Islamic finance is fascinating and deeply rooted in religious principles. It all began around 1,400 years ago with the revelation of the Quran. This holy book laid down the guidelines for permissible economic activities, clearly prohibiting interest, known as riba, while emphasizing ethical business practices and social responsibility. The early practices of Islamic finance can be traced back to the first Muslim community. However, it was during the golden age of Islamic civilization, from the 7th to the 13th centuries, that Sharia-based financial transactions began to take shape and were documented. Fast forward to the 1960s, we see the first modern experiments in Islamic finance. The Mitgammer Islamic Saving Associations in Egypt were pioneers in mobilizing interest-free savings. They provided returns that complied with Sharia law. Around the same time, the Pilgrims Fund Corporation in Malaysia helped Muslims save and invest in Sharia-compliant instruments for their pilgrimage expenses. The 1970s marked a significant turning point with the establishment of Islamic financial institutions. In 1975, the Islamic Development Bank was founded to fund development projects in member countries. This was a major institutional milestone. Then, in 1979, Dubai Islamic Bank became the first modern commercial Islamic bank. That same year also saw the founding of the first Islamic insurance company, known as Takaful, in Sudan. The 1980s and 1990s brought expansion and diversification. Islamic banks began engaging in syndication and project finance. New financial products like equity-based financing and leasing, known as Ijara, were introduced. In 1986, the Amana Income Fund was launched in the United States, marking the first Islamic mutual fund that invested exclusively in Sharia-compliant equities. By the mid-1980s, many Islamic banks had been established across the Muslim world, and even conventional banks began offering Islamic financial products. In 2002, the Islamic Financial Services Board was established to set standards and promote the soundness of the Islamic financial industry globally. Various countries, including Pakistan, incorporated the prohibition of riba into their legal frameworks, reinforcing the regulatory environment for Islamic finance. The growth of Sukuk, or Islamic bonds, became a key instrument in the 2010s, allowing Islamic finance to engage in global capital markets while adhering to Sharia principles. By this time, Islamic finance assets had grown to approximately $2 trillion, reflecting its increasing acceptance in the international financial system. These milestones highlight the ongoing efforts to develop financial products and institutions that comply with Sharia law, promoting risk-sharing and ethical investment. The history of Islamic finance shows a gradual evolution from community-based practices to sophisticated global financial structures, serving both economic and social objectives aligned with Islamic teachings.